I am joined now by the Chief Economic Advisor at Nomura Securities International, David Resler. He's based in New York. Good morning to you, David. I'd like to talk about the US economy today and in particular the US housing market. Now, the US economy is weak, we know that, but what can't seem to be worked out is how to give it the jump start it really needs to get the economy moving properly again.
I think the economy is, as you noted, has softened in the first half of this year relative to expectations. But frankly, most of the data that we've seen, hard data that we've seen in so far in the third quarter, has been consistent with the hope that we'll see a bit stronger growth in the second half of the year than in the first half of the year. That's still leaving economic activity well below what anyone would think of as normal, but we do not yet see evidence that the U.S. economy, at least, is on the brink of recession. Having said that, the financial market turmoil of recent days adds a new element of concern.
Well, investors weren't impressed by the Federal Reserve's announcement last week to purchase $400 billion in longer-term securities, but it also said it would take action to prop up the deflated US housing market. Understandably, home buyers are reluctant to purchase houses due to the current state and near-term outlook for the economy.
Unfortunately, the Fed's actions are likely to have very limited effect on mortgage refinancing and home building activity, primarily because while it will have the effect of lowering mortgage interest rates, and the primary impediment to mortgage lending right now is not so much the level of rates as it is the credit conditions and credit terms that borrowers have to meet in order to refinance a home or to borrow to build a new house. And those terms require a higher equity stake on the part of a homeowner than has been the case in recent years. And that's a direct consequence of the problems that we've come through the last few years. During the housing boom, it was not uncommon to have loans to some borrowers that required no down payment whatsoever, no equity stake. Well, those days are long since past, and now home owners will need to, if they wish to refinance, will have to make sure that they have a fairly sizable equity stake in that new loan, and many households simply can't meet that requirement now.
It's becoming more evident and more unrealistic to expect a short-term recovery in the housing market at the moment, but when can we expect to see a real turnaround?
I think at best we can hope for a gradual improvement as house prices stabilize, and it gives more traction for those people sitting on the fence waiting for the time when house prices do in fact stabilize. So, we'll need several months of stability before we'll start to see some creeping recovery in housing, but we do not expect to see a snapback kind of recovery that we've seen in past economic cycles. It's going to be a long slog for the housing sector to get back to the levels of activity that we saw in, say, 5 or 6 years ago.
So would you say it's fair to say limited access to credit, rising unemployment and waning consumer confidence is going to continue to suppress growth and in turn recovery for a while at least?
Yes, it's going to be a good while for all of that to happen.
Thank you, David. It was a pleasure speaking to you. Diggers Copy TV will be interviewing even more high-profile financial professionals throughout the week, so make sure you check back in. Goodbye for now.